And the reason is that technicals will fail long before the fundamentals will fail. Rule 6, sell strategy. And again, this is the backbone of what we do at Revere here. It's also the question that you really want to ask anybody that's going to be investing your money. And this again gets to the 200-day moving average right here. This is the rule that'll prevent financial ruin. You always hear the pundits on TV talking about, but if you're out of the market, you miss the best days, and you can't make money that way. But what they'll never say is that since 1960, 22 of the worst 25 days and 83 out of 100 occurred when we were under the 200-day moving average on the S&P 500. The overall average monthly return of the S&P 500 is a positive 0.88%, but when you're under the 200-day moving average, the return is negative 2.6%. So basically, the only time it's okay not to have a sell strategy is never. All of the great legendary people that manage people's money, with the exception of Warren Buffett, everybody's always going to bring him up. Yeah, he takes a very long-term view, but it is very difficult to come back from, you saw the stats that I put together. The leading stocks, when they top, on average, they fall 72% from their peak. Getting back to that first chart that I showed, that means you need a 257% gain to get back to even. So rule 7, if we're going to get into the market, we need to have low risk entry points. FOMO, that's fear of missing out, is the worst thing you can do by chasing a stock. We're always looking for low risk entry points. When you're in an uptrending market, high volume breakouts like a cup and handle or a gap up are high probability. We are not in an uptrending market right now. So the best thing you want to do is look for a low volume pullback. And pretty much all of the entries that we've been making lately have been pullbacks into support, because when you're in a range bound market, you want to lean to get in at the lower end of the range and get out at the top end of the range. Rule 8, keep out of the dumpster. No dumpster diving. A lot of money is lost by people saying it's too cheap, it can't go any lower. A stock can remain irrational longer than your portfolio can remain solvent. It's just, we just don't dumpster dive here. Rule 9, and this is besides the new that I'm looking for in a stock, I'm also looking for the relative strength. The stock can have something new, a company can have something new, but if it's not showing up by outperforming in the market, I don't want to be invested in it. Relative strength is what compares a stock or an ETF to what all other stocks or the indexes are doing in the market, and you always want to monitor relative strength. This is another way to avoid those value traps. Rule 10, know the game. You need to know what type of market you're in, as I've mentioned before, and also understand people that you see on TV are usually sell side. They're always pushing a product or pushing a stock on you. Remember that mutual funds have to stay invested. Most of them can't go to more than 5% cash. They don't make money if you don't buy their funds, and if you sell, they don't make money. They want you in all the time. There are a couple of other Wall Street mantras on here. You can review them if you review the video, but it's really summed up by trade what you see, not what you think. Trade the market you have, not the market you want. I would love to have a raging bull market right now. We don't have one right now. We're in a trending market. Money's rotating out of leaders into defensive stocks. Rule 11, building and managing your portfolio. Again, you want to be in an uptrend, and you want to track the indexes, then track asset classes, then pick the stocks and ETFs that are going to put the wind at your back, not the wind at your face. And tracking progress is critical. I'm going to go through a couple of tools that I use to track things. Rule 12, Mr. No Opinion. I either close every video I do by saying, telling it like it is, which was a Howard Cosell line, or Sergeant Joe Friday, just the facts. Keep your mind open, maintain flexibility. Opinions don't mean anything. The only thing that matters is what is happening in the market and how that compares historically to other points in the market. And again, one more time, it's okay to be wrong. It's not okay to stay wrong. And then finally, Rule 13 is a commitment to Rules 1 to 12. It's not an a la carte menu. You need to pay attention to every one of the 12 rules that I've talked about so that you can choose the pain of discipline or the later pain of regret. And again, the growth portfolio that I manage is Growtection. During uptrends, we're actively looking to grow capital. During corrections like we're in right now, we're really just looking to maintain the capital that we've gained, cut our losses, minimize new entries, and if we enter, it's going to be at a low risk entry point. And then during downtrends, actively employ disciplined capital protection techniques. So those are the 13 rules. Any questions? Type them into the chat window. Let me scroll through very quickly to see if anybody's got anything. Nothing jumps out right now, so let's move on to the new thing, and that is going to be the trend gauge. So this is the current trend gauge, and ironically, it looks just like the sample that I looked at, that I brought up in the V13 list, the rules list. So right now you can see we're under a declining 21-day exponential moving average. This is the most important indicator to me. We're at a -2. That means take cover, start to protect your portfolio. Then take a look at next at the 50-day moving average. We're trending under that also. None of the indexes are above it. 200-day moving average, we've got a mixed bag. And again, this gets back to knowing the market that you have. When you're in an uptrend, you can buy breakouts and buy at support. We're in a consolidation right now. The buy breakout box is not checked. This is why a lot of CanSlim or Investors Business Daily people get chopped up. It's buying stocks when you're not in an uptrend, and you absolutely can't do it. You either need to buy at support, get a low risk entry, or when you come into resistance. And what you see a lot with leaders is that you've got the 21-day exponential moving average rolling over. The leaders are rallying up into it and they're failing. And that's the time to get out. And then if we go into protracted downtrend, which means we would break the 200-day moving average, any rallies want to be sold or shorted, and definitely sell a breakdown. So that's the trend gauge. Here is my watch list. This is what I keep on a separate screen on every minute going on during the market, and what I'm focused on is several different things. Let me get my marker here ready. So first of all, inverse ETFs. If we own them, I want to be monitoring them. Then here are some things that we own in the Growtection portfolio. I always want to see how they're doing. And what jumps out right now is some of the leaders that are owned. I've got half positions in some of these. They are lagging versus what the market's doing. Autodesk reported overnight they had a terrible report. Vive initially gapped up and then it started selling off, but you've been seeing relative strength on this IGV. I focus on these two every day, the SOX and IGV for tech, and IGV is a good indicator for what's going on with the software sector and with leading stocks. So you can see a lot of other software stocks that I keep an eye on in here are having difficult days. So this is totally, if you would listen on the way home in the market, and you would hear that the market was, the Dow Jones Industrial Average was up 200 points today, you would know nothing about leadership rotating into more defensive areas. So these are a lot of stocks that are on my watch list. Down here, I'm keeping track of the indexes. Over here, I always want to know what the big FANG stocks are doing. Currencies, this is the dollar, the euro, and the yen. Gold, which has been a leader lately, taken a little bit of a break today, but it's been extended. And then these are all the individual ETFs that I track: biotech, transports, retail, aerospace, builders, a couple of oil ones, the big banks, financials, and then the spider sectors, basic materials, XLC, that's communications, industrials, tech, staples. You can see tech is down today. Utilities also down today. Real estate up. Healthcare, just consumer discretionary, junk bonds, emerging markets, foreign stocks, and silver, which has joined gold in rallying. And then over here, these are some of the holdings of the blue chip income portfolio. And if we hedge, we also purchase some of these. These are basically indexes that rate covered calls. So they have a triple the income of the normal indexes. And we use these as some of the ballast, so to speak, on the blue chip income portfolio. Always want to know what the VIX is doing. Marijuana ETF. This is an example of what happens when you latch onto a story and you won't let go of it. Marijuana stocks, you hear everybody talking about how you need to get in them. They're one of the worst performing groups of the year. After they had a nice run, they've given back 50%. A couple of Chinese names that I always monitor. These are more broad ETFs that provide a dividend. Here are some holdings in the blue chip income portfolio, some things that I'm monitoring to see if they would be bought in the blue chip income portfolio. And then these are some things that are on my watch list as far as just things I want to keep an eye on, something maybe on the 21 over 21 list. So that's the watch list that I maintain. Somebody emailed about how do you maintain your watch lists. It's flexible. I make changes to it every day. The key thing in the watch list is that you also need to have alerts set so that if something goes into an area that you're interested in, that you're aware of what's going on. And I use MarketSmith to track my alerts. Let me see if there's any other questions in here. Do we ever use options like bear call spreads? No, we very seldom use options in here. A lot of the money is in IRAs, and options are cannot be written except for some covered calls in there. Basically, we use inverse ETFs for hedging and for taking advantage of the downside. Let's see another question. How do you define a breakdown? Yes, a breakdown could be over 3 different time frames. You could break down below the 21-day exponential moving average, which means that the short-term trend has changed. In that case, that would be a break of support, and then a downtrend is when all the moving averages start rolling over and you're trending below them. How do you decide a -1, -2 for the indices? It's percent above and below. It has to do with the slope of the line and how far we are below the 2150 or 200-day exponential moving average. If all the indexes are below the 21, which they are now, and the slope of the line of the 21 is down, you would be at a -2. And that's what you saw on short term. All right, let's move on to the next topic. Indexes, classes, and sectors. Let's go back to the charts here so we can take a look. We looked at the S&P 500. Let's look at all 5 of them that we track, and you're going to see something very similar. So we'll go through these very quickly. Again, we're in the middle of this trading range on the NASDAQ 100, 50-day moving average rolling over. We're trending below the declining 21-day exponential moving average. That's the green line. We're above the 200-day moving average, which is still rising on the NASDAQ 100 and the S&P 500. So that's the positive in the market. Again, if we get back over here to where we see a breakdown below the 200-day moving average, that's when we really start to take our most defensive action. And that's what we did during the fourth quarter. Dow Jones Industrial Average, less healthy than the S&P 500. As you can see, it's using the 200-day moving average as support. Several touches of it. Remember, the more this gets touched, the weaker it gets. You've also got the declining 21 and the rolling over 50. Mid caps, nobody talks about the mid cap index more, but this is really where the next crop of leaders comes from, and it's something I pay a lot of attention to. Again, you can see the 21-day rolling over, that's the green line. the red rolling over, and we're battling back and forth along the 200-day moving average. We really don't want to break this 332.77 area. And then finally, the weakest of the index, we've been talking about this for a while. You can see from a relative strength standpoint, this peaked all the way back here in February. And everybody I see on TV saying, got to get into the small caps, they can't underperform forever. But if you want to do that, that's on you. We took a shot here when it was an attempt to break out above this resistance. It failed in a day, got back out of it, quickly broke the 50-day moving average, and now you can see we're in this big trading range here, but it's occurring below the 200-day moving average. Now you've got the 21 that's broken below the 200, and the 50, the red line, is preparing to break below the 200-day moving average. I've also got a 100-day moving average on here. That's the purple line, but I don't really reference that much. So that's the 5 major indexes. Let's go to the spider sectors now. This is the next level down as far as trying to determine how we're doing. There's 11 of these. It's basically how you chop up the S&P 500. Basic materials riding the 200-day moving average. Energy has been, this is an example of rallying up and failing at a big resistance point. You can see several times energy has tried to come off the bottom, but all it does is run into the declining 200-day moving average, and this is why energy has been in a bear since it broke back here in early October. Communication services, this is Facebook, Google, one of the more healthy ones, but again in the same type of trading range, but holding the 200-day moving average for now. You can see the relative strength of a 71. You compare that to the S&P 500. The relative strength of the S&P 500 is usually pretty consistent right around a 71. That means the S&P 500, the SPY, in this case, the index for it, outperforms 71% of all stocks that are in the universe that MarketSmith tracks. Moving on here to financials. Financials have been very choppy lately. Tried to take a leadership role a couple weeks back. That failed miserably. This was about the time when we started getting close to the yield curve inverting, the Fed cut rates, and that's kind of when the correction started taking hold. You can see the relative strength declining over the last 4 or 5 weeks on it. Industrials, this looks a lot like the 200-day, like the chart of the Dow Jones Industrials, and I think you can tell why. Technology, still the leader, a little bit of rolling over the last week, but the strongest relative strength, 83, with the exception of, I think, real estate is above it. Consumer staples, this is where money has been flowing into. This is a very healthy chart, trending above all the moving averages. See, you've got the 200-day black line, you've got the red line, and you've got the green line, 21. Money flowing into staples, and look at the relative strength of this. This coincides with the relative strength declining on tech that I showed. Real estate, again, a safe haven. You see the relative strength, money flowing into it. Utilities, again, a safe haven. You see money flowing into it. Healthcare, a little bit of a mixed bag, struggling below the 200-day moving average. This has a big weight by Johnson & Johnson, and that impacts it quite a bit. Consumer discretionary, this is basically Amazon, Home Depot, and a few other stocks. Looks a lot like the S&P 500. You can't get above the 50-day moving average, battling the 21, but still above the 200-day moving average. I'm not going to show the stocks of all the sectors except for a couple of select ones. Very important, IGV. We recognized that this was going to be a leader. Get my pen here. Because the relative strength continued up during the November and December. You went sideways, even though it was declining, but relative strength was staying strong. And then mid-November, the relative strength, and you can look back in the videos, I pointed this out, we knew that this was going to be a leading sector when the market righted itself. The market righted itself on January 4th. That's when we had a follow-through day. The relative strength continued up through here, and then it's just been tracking sideways, and then we started rolling over about 5 weeks ago, and this is really when the correction started. taking a little bit more of a hold. You can see high selling in this as it broke the 21-day exponential moving average, then broke the 50-day moving average, and then any rallies up have been contained by the 50-day moving average here. Got a question here. It says, how do you find the best inverse ETFs to buy? I have MarketSmith, but it doesn't tell you how to make money in down markets. Shorting, and basically what you want to do with inverse ETFs, let me bring up the S&P 500 here. It gets to that chart that I showed before, where you want to short the top of the range and get out, or short a breakdown. But really, you're looking to take inverse ETF positions into, as you rally into former support that becomes resistance. In this case, the S&P 500, you see very clearly the 50-day moving average has turned into resistance. So when you rally up into here, you would get into an inverse ETF. When you get near the bottom of the range, you can exit it, or if you break down through here, that's also an opportunity to take advantage of it. So you're either shorting breakdowns or shorting at the top of the range. Okay, back to the agenda. Secondary indicators. I have, you'll notice I've been talking a lot about these lately, and the fear and greed index at extreme fear, this can go a lot lower. Just because you get into extreme fear, it doesn't mean buy. This is a secondary indicator. It's something I keep an eye on. We're up a little bit today. The prior close was 16 because the market's rallying. This is just an oversold rally with money rotating into defensive sectors and out of the stronger tech sector. And leaders are not participating. The current leader crop is not participating in this rally today, which again tells me it's not a positive sign for the market. CBOE put call ratio. I talk about this. Tim talks about this. This is high. This is elevated, and this coincided with putting in the low today. When you see high levels like this around 1.4, this is about the time the market started rallying, and you see that all the time. When you're high like that on the put call ratio, if you get too high, you're done going down, at least for the day, while the put call is elevated like that, and that played out today. NASI, this is a headwind tailwind summation index. You can see we hooked up here, but we're still oversold. So we track the RSI and also the direction of the summation index. Right now we're oversold. You get back above this 30 level, and the markets get back above the 50-day moving average. We can start take some longs with it. We have to assess the crop of leaders at that point. I'll go to my 21/21 list, see what is at a low risk entry point, and start dipping back into the market. But we're always looking for low risk entry points when the market is in a tenuous situation like it's in right now. And then finally, the VIX Central. You can see here we've got a mixed bag. The dotted green line is the cash VIX. The blue line is the future month VIX contracts. So you can see where ideally what you want is you want the slope of this line going from lower to higher, like you're driving from Arizona up to Maine. That is bullish. When you don't see that, it's bullish for stocks. When you don't see that, you got to pay attention to what's going on in the market. You're very consistently going from Arizona to Maine when the market is in a strong uptrend. But when you get inverted here the way you are from October to December, and we've been playing with the inversion and the cash being higher and lower, something Tim and I pay attention to, and it's telling you to get defensive. Okay, secondary indicators. Let's talk some risk management right here. And again, risk management always starts out with what's the state of the market and what's the trend gauge. Additionally, I use two tools to assess my position sizing, and I always want to know where I stand as far as what's the downside, what's the maximum amount of capital that I've got at risk. it helps two things. For one thing, if you know that your stops would get hit or you would be hedged when you've got 3% downside, then great. You know that you can take action, and you can your stops will take you out of the market. Here's an example of the position sizing spreadsheet that I use. So before I make any buy, I've got several examples on here of some things that we own, some inverse ETFs. I need to know, and this is one of the things that William O'Neill doesn't teach you. They tell you that everything, that you take a 7%, 7 to 8% loss on everything, but they don't take into consideration what the ATR is of the security that you're getting into. For example, if you wanted to take an entry into Beyond, this thing moves 7% on a daily basis. Compare that with an entry into something like Chipotle down here. This only moves 2% on an ATR basis. So you would have to move 3 times the ATR on Chipotle before you would get stopped out, compared to just 1 ATR on Beyond where you would get stopped out. So that's why I use this to determine what my position size is going to be whenever I take an entry. So I've got my buy. I'm looking on the charts to determine what my stop is. This gives me my stop percentage. I go over here, and this column, I never want to lose more than 1/3 of a percent on any individual entry. Some people use 1%. I use 1/3 of a percent normally. On stocks, I'll widen it sometimes. On ETFs, I use 1/2 of a percent. And then I plug in what the ATR is. You divide the ATR by the price. This gives you an ATR percentage. If you've got a portfolio full of Beyonds, you're going to get stopped out left and right. Things like Snapchat, APPN, they've got about a 4.5%. So you've got at least a 2 ATR before you would get to that 8% stop down. I like to have things like, I prefer things like Chipotle mixed in, so that I know it's going to smooth the equity curve, and it allows me to take a different position size. So I vary my position size depending on the ATR. I don't just blindly buy a certain percentage, and I don't just set my stop blindly at 7 or 8%. I always want to know what my stop percentage is going to be, and then to fit into the 1/3 of a percent or 0.5% drawdown on the overall portfolio, not just the flat 7%, which is which is what they teach. So this is one thing where I deviate with that rule from O'Neill. And then the next thing is balance at risk. This is something that helps me stay. This is something that basically helps me sleep better at night. So in the growth portfolio, I'm always keeping track of what I own, where I bought it, what the current position is, whether it's a gain or a loss, what the position size is, what my stop is, and this will tell me what the drawdown impact is on the overall portfolio. So for example, let's take over the last 3 weeks, a sample portfolio that had about a $315,000 balance. The balance at risk, if all the stops were hit and no hedges were added, the downside is 5%. So this lets me know my downside is at 5%. It allows me to pay less attention to the individual holdings and give them the room to breathe down to their stops, knowing that if they all get taken out, no big deal. I'm down 5%. 5% drawdown off of a high is very manageable. If you refer back to that chart that I showed at the very beginning, you only need a 5.3% gain to come back from a 5% loss. But it's when your drawdown approaches, 15, 20% that you've really got problems rebuilding your capital base back. So as of right now, 311.5K balance, drawdown 3.83%. This allows for individual drawdowns in the stocks with about a 200 basis point wiggle room, and then a little bit added in there. But basically, I know that managing this portfolio, I'm going to be out or everything, or I'm going to be hedged. And the drawdown would only be from 311 to 299. This is the approach that I manage all my retirement money in. It's in the Protection portfolio, and lets me sleep very well at night. And I hear from clients too that the stops that we put in allow them to sleep at night. I'm not going to get 25, 30, 40% drawdown as long as we continue to follow our discipline that we have in here. Okay, let's move on. Let's look at some charts of the Protection and Blue Chip Income portfolios. Here's what we own right now. I just showed it on that rebar chart. So gold, GLG, and GDX we own. These are the percentages, and then just 6 stocks left. The beta of the portfolio is 0.42, and we've got a 62% in cash in Protection. And this has been, cash has been being raised. If you've been watching our videos, you know very well over the last couple of weeks, as the market is, every time it runs into resistance on the upside, it backs back down at the top of the range until we break through the top of the range. We're not going anywhere. We're just looking to maintain our gains and cut our losses if things turn against us. This has been a very nice addition to the portfolio. GLD and GDX, these are in the Protection portfolio, and you can see it's as if it looks like the software stocks look like when they were trending up earlier this week. Touch of the 21, find support, and it just continues to go higher. Relative strength really kicking in since it bottomed back here at the beginning of May. GDX's gold stock, same situation, tested the 21 and held, tested the 21 and holding, continuing to make new highs. Great relative strength. Snapchat is something I got stopped out of yesterday, and this is a lesson here. Look at how the 21-day starts rolling over, and anytime we try to rally back up to it, we can't get through it, and then finally we broke through the 50-day, and the relative strength lagging a little bit, got stopped out on it. The trade desk, both Tim and I got stopped out on this over the past couple of weeks. AVLR, still riding the 21, broke the 21 today for the first time, so I may take half of that position off. Relative strength is maintaining, and the 50-day moving average still going up strongly, but this is teetering on the 21, so I may take this down. This is the largest position right now. I may take that down to half by the end of the day if it doesn't bounce back. But again, as I mentioned, this is a leaders being sold day. Pinterest, low risk entry point, holding the 21, bounced off the 21 today. That's good news for it. We're about break even on this, maybe up a little bit. Team, another situation where with the software stocks, the 21 is starting to roll over. Sitting on the 50-day moving average here, I've got a half position in this. This really needs to hold or it's going to get cut loose. CrowdStrike, we got stopped out on this week when it broke the 21-day exponential moving average, and then look what happened when the 21 rolled over. Every rally back up to it got sold. Now it bounced off the 50-day moving average. Let's see if it can hold there. This is actually a low risk entry point for it, but we're not really looking to take on much more exposure as the market is lagging. Roku, this is the exception. There's an exception to every rule. This is the exception right now. This gapped up on earnings. I took the 43% gain from when I bought it. Looked for a pullback, like similar to what we just saw in Avalar and GH. Didn't get the pullback. That just tells me that this is the strongest stock in the market. I don't kick myself for missing it. I know it'll pull back and touch the 21 at some point, and if the market's still healthy, I'll be back into it. GH, sold a half of this. Had good gains from this. In fact, the last position, we're still sitting on 20+% gains from it, but took half of this off the table today. We're down to about a 3% position on this, and this is close to getting cut loose. See relative strength starting to fade. MasterCard and Visa, Transaction Nation, relative strength continues up. These are just great stocks to be in when the market's trending up, but it doesn't mean we're going to blindly sit with them. But these will probably be the last things to get sold out of the portfolio, MasterCard and Visa. PayPal, we own this for a long time, but you can see when this finally started rolling over, broke the 50-day moving average, gapped down on earnings, and then broke the low of the earnings day, get out of the way, and you can see every time it's coming into the declining 21-day moving average, it's starting to fail. So that's what we own in Grotection, blue chip income. Let's take a look at what we have here. Basically, the rules for blue chip income is it's diverse. Let me bring up the portfolio. Okay, it's diversified across the 11 sectors, and then it also has ETFs with an above average yield. Okay, sometimes there's no healthy stocks in some of these sectors, so that portion of it would just go to cash. Other times, and this is also weighted. There's a big weighting, but like 20% of technology, all the way down to like 3% in utilities, XLRE and XLB, relative to the S&P 500. So we try to weight this portfolio relative to the S&P 500 too. It's got stocks that are not as go-go as what you'll see in the Grotection portfolio or the stock and ETF portfolio, but we've got sell rules regardless of these, and it doesn't do any good to take on a 2 to 3% dividend if your stock is down 14-15%. So again, sell rules apply to this also. And let's take a look at some of the holdings in this. The recent addition, Costco. This is a relative strength play, and then we got great news out of China on it yesterday. So this is probing new highs. Very common to see something run into a round number and back off. The dividend on this is below average, but the income portfolio invests both in blue chip stocks. Some of them have a below average income because we're also looking for capital appreciation on that. There's no better capital appreciation than when your relative strength line is at a new high. Noble, this is an ETF where relative strength is continuing to go up relative to the S&P 500 because this contains the S&P 500 dividend aristocrat stocks. These are stocks that continue to raise their dividends over the past 20 years, regardless of the market cycle. So there's a lot of reliable companies in there. This is where money tends to flow into when the market gets tenuous. LVHD is another low. Again, you can see the relative strength increasing on this. This is money flowing into defensive sectors. This is a low volatility, high dividend index. SPYD, we're out of this. This yields about a 7%, and it sells covered calls, but the trend of it had been down, and once it broke the 200-day moving average, I got out of it. Chevron, this is holding on by a thread. This is one of the best acting. It still has a relative strength of 55. One of the best acting energy stocks. Very small. I think it's a 3.5% exposure to the energy sector. Disney, just kind of trying to build a base here after its gap up. Lockheed Martin has been a nice winner. Continually comes back, touches the 50-day moving average, and continues higher. Abbott Labs, this had a nice move here. Now it's consolidating that move. This is in the drug sector. Microsoft, same situation, leader for a long time, now consolidating. American Tower, this has just been a champ. This actually never got sold out of the portfolio during December. It was one of the things that held up above the 200-day moving average, and this is one where we're just letting it ride, and you can see the relative strength kicking in on this as money flows into this type of defensive stock. And NextEra Energy, same situation. This never broke the 200-day moving average except for a day here. Didn't get stopped out of it. AMT and NEE were the two remaining. We were down to just NEE and AMT in the blue chip income portfolio during the fourth quarter. So those are the two portfolios. What is next? Q&A and charts on request. We've got 10 minutes left. So let's see what questions I haven't addressed yet. Is there a poor man's relative strength alternative? There is not. You don't have to have MarketSmith though. Relative strength shows up on an IBD or investors.com subscription, which is very reasonably priced. MarketSmith gives you 3-month relative strength as well as 6-month, which I pay a lot of attention to, but you can still get relative strength and the trend of the line just by subscribing to investors.com and using those charts instead of the MarketSmith charts. Do you use hard stops with orders or use mental stops? We take alerts, and then there are no hard alerts set. It's always I'm sorry, there are no hard stops. The algos will come and get them, plain and simple. When you place hard stops out there, the algos see them. They will come. They'll collect your stocks and move on. So no, we take action after we get alerts set up. RSI, you're confusing. Okay, RSI was near 23 from what I saw. Usually 30 is low. Yes. This would be strongly oversold. Yes. Usually 30 is oversold. Yes. This is the case in the NASI, and what we're looking for is this to come off of oversold and start trending higher and coinciding with the market breaking back above the 50-day moving average. This would give us more confidence to get long. So we're monitoring. That's one of the secondary indicators that I monitor. Stock charts, SCTR is a form of relative strength that can be used for free. I didn't know that. I use stock chart. I have stock charts, but I use it rarely because I get everything I want out of MarketSmith. 1/3 AT at the total portfolio level. Yes, that's correct. 0.3% at the total portfolio level. That's the most I want to lose in an entry in an individual stock. Are your stops hard stock or do you have orders again? No, we set alerts, and the alerts correspond to areas of support that better hold. If not, it tells us something to take action. Are stops placed at 2 ATR and then position size base, or the stop you use moving average? 2 ATR is a guideline. I don't always put my stops at ATR. I am looking to compare the ATR and the 2 ATR to what a moving average or a key horizontal level of support would be, and that's how I determine my position size. Asking about what size accounts do you manage and what is the fee? Contact me offline. We have never turned a single client down. We're looking to establish relationships. We have people with as small as $5,000 with us, but we do have minimums for different portfolios. And if you're interested, we would love to have that discussion with you. We have 5 different portfolios ranging from ETF, stock and ETF, blue chip income. Let's talk about the Robotection portfolio that I didn't go through. This is basically just our asset class model. It invests in 7 asset classes, and the asset class needs to be in an uptrend. It starts out with the broad market, S&P 500. We're still long this as long as we're above the 200-day moving average. Then we go to international stocks. We got stopped out of this. Come on, MarketSmith. We got stopped out of this when we broke the 200-day moving average. It figures my charts don't want to work just when I'm wanting to show them. Sometimes we do have overlap, and we do take into consideration so that we don't have too much exposure to any single client portfolio. So nothing to be concerned with there. Okay, here's international stocks. You can see we got back into it when it got back above the 200-day moving average and made a higher close, ran into resistance. We got stopped out for a very small loss, and it's trending below the 200-day moving average. Then we go into bonds. BND is the ETF that we use. We are long in this right now in our Robotection portfolio. Again, this is just broad asset classes, and we're riding trends with stops. So this is like a pie chart. Pie charts don't have stops. We do have stops. Emerging markets, we got stopped out of this. This is the EM ETF, again, when it broke the 200-day moving average. XLE, we haven't been in this, and I can't tell you how long since we broke the 200-day moving average back here. XLRE, we've got long positions in this. This is real estate. And finally, GLD, we took a long position in this when it broke out back here. Any other questions or any charts you want to take a look at? Yes, minimums for certain portfolios are due to transaction costs. Any in particular charts you want me to bring up? We've got a couple of minutes left. Just type the ticker into the window. If not, I'll take a look at, I've been talking about a Fab 5 on the videos lately, and let's go through those very quickly. APPN, finally getting a pullback. I'd love to get an entry on this if it came back into the 21 and the market righted itself. Roku, we looked at this. This is the strongest stock in the market. TDG, TransDigm, acted very well. Undercut test, held the 500 level, very nice, and now getting a bounce today back above the 21-day exponential moving average. Pinterest, I still own this in Grotection, bounced off the 21-day moving average today, so that's still looking good. And finally, Shopify, another leader, looking for a low-risk entry on this after this breakout. Looks great. Shop, we were just asked about Shop, looks great. Probably would have taken an entry in this if the market, if we hadn't been reducing exposure over the last couple of weeks, but the last thing you want to do is chase a stock in a questionable market. I've been asked about Apple. Apple is kind of, this is maybe one of the keys to the market. It's holding this rising 150-day moving average. You can see very harsh break of the 200-day moving average. Everybody got maximally bearish about Apple back here. Started to recover, got back above the 200, failed breakout on its earnings report. Nice volume up, but as soon as you break the low of the breakout, the low of the gap up day, and then you can see tests higher on it have failed to get back above the low of that gap up day. That coincides about with this 215 level, which was the top of the cup that formed. But right now it's holding okay. Relative strength is trending up. Apple is a port in the storm for a lot of portfolio managers. Tandem, strong stock. Diabetes. Nice move back up above these stacked moving averages here after this nice flat base had formed here. It's strong coming into a big resistance area between 70 and 72 here. BX, very nice. They moved from, I'm not sure if it was BlackRock or Blackstone. I think it was Blackstone. This gap up here coincided with them going from a limited partnership to a corporate structure. That opened them up for a lot of investment, and this is just acting very nicely. You can see every pullback to the 50 and the 100-day moving average is being bought, holding up very well. China, KWeb, yeah. KWeb is, this is one I keep an eye on. This is the equivalent of the big China tech and internet names, and it's trending below the 200-day moving average. We owned this a little while back. When it broke the 200, we got out. And every test trying to get above the 200-day moving average has been sold. Now you notice some relative strength improving over the last 3 weeks on it. Some of that because Alibaba had a good earnings report, some of that because it's coming into this 36 level, which is the 52-week low, and sometimes things just can't go any lower than they are now. But as you can see, it's running into this declining 50-day moving average and can't get above it. The China, as far as stocks listed on the China market, ASHR, A share is the ticker symbol. This a little bit healthier, holding the 200-day moving average, can't get back above the 50-day. And we're at 101, nothing more in the chat box. That's going to wrap it. Thanks for joining. I will send a recording out of this. I missed like about the first 5 minutes of the recording, but it comes in right at the beginning of the 13 rules. And I'll send it out to everybody that replied. Thanks for listening, and appreciate it. And this is just me telling it like it is. Have a great day.